So a lot of people have been saying that the reason the stock market, or one of the reasons the stock market has just been setting records, and it's just been incredible, is the share buybacks.
Right.
And so companies like AT&T, Ford, Heinz, et cetera, there's a whole bunch more, of course, have been borrowing. They've been doing bonds, right, to buy their shares back, and those bonds, which might have been AAA, are now triple B. And
Yes.
as you go down that ladder, the next step down is high yield or junk bond status.
That's correct.
Okay.
And the big reason that's important to understand, because the pension funds have been supplying the majority of this liquidity or cash to the corporate bond market. So taking it even a step further back, why they've been doing that? Because the Fed dropped interest rates to zero for so long, and these pension funds have to have a 7% return to meet their liabilities. So if you can typically go into a 10-year treasury and get 5 or 6%, well, it's not going to be that hard for that pension fund to meet their obligations. If you can only get 1 or 2% on a 10-year treasury, now you've got real big problems. So the pension fund managers said, well, what do we do? Let's go somewhere where we can get a little bit more yield. Let's go into the corporate bond market. So I want to be clear that that was a result of the Fed policy. It was an unintended consequence of what the Fed did. So the pension funds take all this cash, go into the corporate bond market. The corporations, to your point, take that money. What do they do with it? They just buy their own shares back, because it's just this financial engineering where the CEOs can pay themselves more. It looks like their earnings per share goes up, but all they're doing is just borrowing to buy something that gives them a sugar rush.
Mm-hmm.
And at some point in time, they've got to pay the fiddler. If their cash flows stay consistent, like with AT&T, then okay, they might be able to service that debt. Not a big deal. And what most of the bulls point out is that, well, the cost of servicing that debt is extremely low right now because of this low interest rate environment. But what they're not saying is that that debt rolls over. And a lot of these corporations have to roll it over every 2 years, every 5 years. And then they're assuming that their cash flows stay consistent. Well, like and I'm sure a lot of your listeners know, that in a recession or in a depression, the cash flows of these companies plummet.
Mm-hmm.
So if you have a situation where the cash flows are plummeting and the stock market is going down, so that's creating this situation where a lot of their debt, meaning those corporations, is getting downgraded into junk, which means the interest rate on that debt goes through the roof. So,
Like what does through the roof mean? What's the differential there? I mean, of course, it varies by company and such,
yeah,
but give us an idea.
well, if this plays out, I think it could double easily.
So the debt load, or the cost of servicing the debt, doubles for these
Yeah, I mean,
companies.
let's just look at it like a mortgage. I think
Okay.
that's the easiest way to
Mm-hmm.
describe it. So you're a real estate investor, and you take out, you're buying $100,000 home, and you're taking out a mortgage. Let's say your interest rate is 4%, and your monthly payment is X, and after you do all the math, you're $200 cash flow positive. And as your listeners, because they're smart, they take out fixed rate debt, so they don't have to worry about these things.
Right. Yeah. Right.
But the corporate bond market isn't 30-year fixed rate debt. It rolls over. So
The big companies don't have Fannie Mae and Freddie Mac subsidizing their
no,
loans. Yeah.
no, they don't. So when that debt rolls over, if it's now, call it 8%, you can imagine what that would do to that positive cash flow that you had in that rental property. Now all of a
Hmm.
sudden you're probably cash flow negative.
Yeah. Right. Yeah.
So, and that's just that's a microcosm of what's going on in the corporate bond market. In addition to that, taking it back to the real estate example, the corporation's cash flow gets slashed. So imagine having a rental property where your interest rate on your mortgage doubles, but your rent goes from $1,000 a month to $400 a month.
Mm-hmm.
And
Yeah.
and that's the situation. And then you take it a step further, and the entire real estate market has been built on real estate investors buying more real estate properties.
Right. Yep. And what you're doing is you're just making the comparison with the stock market
Correct.
and the large companies that
Yeah, I'm
have
not
this
saying
debt
that's
problem.
happening. I'm just
Yeah.
using that as an example that most of your listeners can
Great.
easily
Right.
understand
Yeah.
because they're real estate investors. So if the entire real estate market has been propped up by real estate investors going in and
Mhm.
buying these properties because they're cash flow positive, if all those buyers go away,
Right.
then the real estate market drops,
So
plus the cash flows drop, plus the cost of servicing the debt goes up.
right.
You just have this.
And wait a second though. Before coronavirus, everybody was talking about the everything bubble, okay, and certainly about the stock market bubble specifically. We have out of whack valuations before any of this started, right? With PE ratios in the stratosphere, price to earnings ratios, where any that the stock market is like a cyclical real estate market. It's like buying in areas that we would never recommend, like, expensive West Coast of the United States markets or expensive Northeastern markets or Miami. These markets just they were too expensive to begin with. They had completely out of whack price to earnings ratios, or in real estate we use rent to value ratios.
Right.
Same idea. And so now you add to it this situation with their financing getting a lot more expensive, and these companies are in trouble.
They absolutely are. But it's not just these companies that are in trouble, because there's a direct correlation between those companies and the overall stock market. And unfortunately, our economy has been so financialized
Yeah,
over the past 20 years that now it's the tail wagging the dog.
sure.
Where the stock market should be a reflection of the economy. Now it's not. It has nothing to do with the economy, but the economy is completely reliant upon the stock market because of demographics, because of the baby boomers having their 401k. They're going to be taking that out. It's all about consumer spending. It's all about confidence. I've been saying this on Twitter and my videos a lot lately, that this whole system is built on confidence. And if that confidence goes, the whole house of cards comes crashing down.
Right.
And I think, let me get to, do you want me to explain this a little further, or do you want me to go to the next slide?
I think we got the idea. I mean, let's just sum it up before we go on.
Yeah,
I
the
mean,
main thing to
yeah,
understand with this is the line, the 15% and below is junk debt. The 85% above that line currently is investment grade debt, and the pension funds can only invest in investment grade debt. That's the key takeaway from this picture.